Imagine waking up one day to find that the money in your bank account isn't just losing value, it's silently being reshaped to serve a system you'll never see, controlled by institutions most people barely understand. Every financial crisis, every sudden market crash, and even the occasional bailout isn't random chaos. Behind the headlines, central banks quietly turn moments of panic into permanent control, and most people never notice. Today, we're uncovering the hidden mechanics behind this shadowy system, revealing how crises are transformed into long-term power.
To understand this, we need to go back over a century. Central banks didn't always wield the kind of influence they do today. The Federal Reserve in the United States, the Bank of England, and other major institutions began as supposed stabilizers, mechanisms to prevent economic collapse, protect depositors, and smooth financial cycles. Yet from the start, there was a tension. While central banks promised stability, they were also designed to serve governments and large financial interests. Figures like Paul Warburg, John Maynard Keynes, and later Alan Greenspan shaped not only policies, but the philosophy that crises themselves could be tools, not just threats, for shaping financial behavior. The twist? What if the very crises these institutions claim to solve are sometimes necessary to expand their control?
The concept of using crises to consolidate financial power isn't new. In the early 20th century, banks discovered that panic, bank runs, stock collapses, and economic shocks often forced governments to accept central bank intervention. Take the Panic of 1907. When major banks teetered on the brink of collapse, J.P. Morgan orchestrated a private bailout, coordinating with other financiers to stabilize the system. The public saw a crisis, but behind closed doors, elites learned a critical lesson. Panic could be leveraged to enforce structural changes in finance. Central banks, once formalized later with the Federal Reserve Act of 1913, institutionalized this lesson, creating a system where crises justified more centralized authority.
Fast forward to the Great Depression. Governments were desperate, unemployment soared, banks failed, and social unrest simmered. Here, central banks stepped in as saviors. But the methods weren't just about saving the economy. Programs like the New Deal, while popular, cemented a pattern. Crisis becomes the excuse for central banks to expand influence, reshape regulations, and control money supply in unprecedented ways. Another turning point, post-1971, when the United States abandoned the gold standard. Currency became fiat money, untethered from tangible assets. This gave central banks enormous power to manipulate value, interest rates, and liquidity. Crises, both real and engineered, suddenly became tools to enforce new economic frameworks. Inflation spikes, recessions, or financial bubbles were no longer just side effects. They became mechanisms to adjust the system in favor of those who controlled it.
Consider the 2008 global financial crisis. Subprime mortgages collapsed, banks teetered, and millions lost homes and jobs. Public outrage was immense. But notice the pattern. Central banks didn't just stabilize the economy, they permanently increased their influence. Through programs like quantitative easing, central banks bought trillions in assets, effectively nationalizing risk while keeping private profits largely intact. Interest rates were lowered to historic lows, not as a temporary fix, but as a long-term strategy to shape investment behavior, debt accumulation, and even consumer spending. The crisis wasn't just managed, it was transformed into a permanent restructuring of financial control, unseen by most everyday people.
The fallout of each crisis reinforces dependence. Individuals, businesses, and governments become accustomed to intervention. People assume that whenever markets fail, central banks will save them. But in reality, every rescue subtly shifts power upward, concentrating influence among a few players and making economies more sensitive to the next intervention. Look at modern debt levels. Global debt now exceeds $300 trillion, a figure few comprehend. Each crisis justifies new measures, bailouts, stimulus packages, or interest rate manipulation that cement the central bank's role as the ultimate arbiter of financial life. Ordinary citizens bear the risk. Central banks reap influence.
Repeated crises have spawned reforms meant to prevent repeat disasters. Glass-Steagall in the 1930s, Dodd-Frank in 2010, each intended to limit systemic risk. Yet these measures often fail. Why? Because the underlying incentive is not prevention but control. Structural flaws aren't bugs, they're features. Crises are essential tools for consolidating authority, and failed fixes often reinforce the central bank's ability to act decisively in the next panic.
Today, this pattern repeats. The COVID-19 pandemic triggered unprecedented monetary expansion. Central banks injected trillions in liquidity, lowered interest rates to near zero, and purchased assets at a scale never seen before. Stock markets rebounded quickly, while wage growth stagnated and national debts exploded. Pattern recognition is simple: crisis, intervention, concentration of power. Even inflation surges can serve the same purpose: devalue currency, restructure debt obligations, and shift wealth upward, all under the guise of economic management. Recent studies show that over 60% of all money in circulation in developed nations exists as digital bank credit, created out of thin air, fractional banking in overdrive. Each crisis, whether pandemic, recession, or geopolitical shock, is now a rehearsed scenario to expand monetary authority invisibly.
Crises are tools, not accidents. Central banks use financial shocks strategically to reshape economies and consolidate influence. Control is invisible but pervasive. Every bailout, every policy adjustment subtly shifts power upward, often unnoticed by the public. History repeats itself. From 1907 to 2020, patterns of intervention reveal a system designed to perpetuate dependence on central authority.
The quiet truth is unsettling. Your money, your savings, and even entire national economies are shaped by forces few understand and even fewer scrutinize. The next crisis will come, as it always does. Will it be managed to protect people, or to strengthen the invisible hands that have quietly controlled the game all along? If you found this dive into financial secrets eye-opening, make sure to hit like and subscribe. Share this video with someone who trusts their money blindly, because awareness is the first step toward understanding a system built to operate in shadows. And don't forget to comment your thoughts. What do you think is the next big crisis central banks will use to expand control?